We all love getting dividend payments, but did you know that depending on what kind of dividend you're getting paid, the tax you owe on that dividend could be wildly different? Today, we're going to look at qualified dividends, ordinary dividends, capital dividends, and foreign dividends, and see how each of them are taxed differently and what we can do to minimize that burden. And we're starting now. Welcome back to the channel, everybody. My name is Jay, and in a recent video, I took a look at the QYLD ETF. If you missed that video, I'll link it in the description, check it out. But what I really didn't expect to come from that video was a lot of discussion about taxes. You see, the way the QYLD ETF works, it generates kind of a complex system for reporting the taxes on the dividends it pays out to people. So that generated a lot of back and forth in the comments and people asking questions and people explaining taxes to people. So I figured I'll just make a video explaining all the different kinds of dividends that there are and how they're taxed. So that way we can all gain a little more knowledge about this, because if we're gonna be dividend investors, it pays to know how our dividends are gonna be taxed. We'll start it off easy. We'll start it off with qualified dividends. Qualified dividends are generally what most of us will be thinking of when we talk about receiving a dividend payment from our favorite stock. To be a qualified dividend, the dividend payment must come from a US company or a qualifying foreign company. So that means any dividends you're receiving on your stocks like Apple or Johnson & Johnson or 3M or any of the other dividend favorites that are out there are gonna be qualified dividends. Now there's a little extra layer to being a qualified dividend, and that's there's a required holding period on the stock. So for that dividend payment that you receive to be taxed as a qualified dividend, there's a holding requirement that you have to meet. We as investors have to have held that stock for at least a 60-day period around the ex-dividend date for common stock. For preferred stock, which not too many people out there hold, I don't think, that goes from 60 days to 90 days. Assuming you're getting your dividend payment from a US company, you've held the stock for a 60-day period on either side of the ex-dividend date, that means your dividends will be taxed at the qualified rate. Qualified dividends have a lower tax rate than many other investments that are out there. Depending on your income level on your taxes and your filing status, the rate you'll pay for qualified dividends will either be 0, 15%, or 20%. And you can see on the chart that's on screen how that breaks down. If a dividend isn't being taxed as a qualified dividend, chances are it's going to be taxed as an ordinary dividend. Now you'll run into it being taxed as an ordinary dividend if you don't meet some of those requirements for the qualified dividend, or if you hold special types of investments like REITs. If you're holding REITs in your account, those distributions, those incomes from your REITs will generally be taxed as an ordinary dividend and not a qualified dividend. The same goes for MLPs, or Master Limited Partnerships. A popular one of those is Kinder Morgan, which is a pipeline company. The ticker symbol is KMI. And the reason that REITs and MLPs are taxed as ordinary dividends instead of qualified dividends is because there are special rules and regulations about how much they have to return to their shareholders in the form of a dividend. Whereas with a company of Johnson & Johnson, it's kind of arbitrary. The board decides what they want to pay out of their earnings. For REITs and MLPs, there's a required distribution that they have to make. Ordinary dividends are taxed as short-term capital gains, which means you're paying your regular taxable income rate. Again, depending on your income level and your filing status, whatever tax rate you're paying on your normal job income, that's what you're gonna end up paying on your ordinary dividends. Now we're gonna get into two scenarios where dividend taxes can get a little weird and a little complex. But before we do, I just wanna remind you, please hit the thumbs up, hit the like button down below. It really does help out me, the video, and the channel, and I'd appreciate it. And this next kind of dividend we ran into in that QYLD ETF review that I did. And that is a capital dividend, or more commonly known as return of capital. I hesitate to call return of capital a dividend because it's not really a dividend at all. And that's because return of capital is just what it sounds like. Whereas with qualified dividends and even ordinary dividends, what you're being paid is coming out of a company's earnings. With return of capital, you're not being paid back out of the earnings of that investment, you're being paid back out of the invested capital. So it's just returning capital back to you. And for that reason, return of capital is not taxed. What it does is, instead of being taxed as income or a dividend or something like that, return of capital lowers your cost basis on the investment. As an example of return on capital, assume I bought QYLD for $10 a share. At the end of the year, they've paid out $1 per share in dividends that got classified as return of capital. Instead of me having to pay tax on that $1 per share of dividends I've been receiving throughout the year, because it got classified as return of capital, my cost basis for QYLD would go from $10 per share to $9 per share. Specifically talking about QYLD, since that's what inspired all this, in 2020, all of the dividends that ETF paid out were in the form of return of capital. So all of the dividends you would have received on that ETF would have kept lowering your cost basis. Now I know what you're thinking. Well, what happens if my cost basis hits zero? And yes, that is possible. Through return of capital, you can lower your cost basis to zero. When you do that, when you do lower your cost basis down to $0, return of capital then starts getting taxed as ordinary income. There's no such thing as free lunch. You can only get away with that for so long. And then there's the greater debate on whether return of capital is a good thing or bad thing to begin with, but that is for an entirely different video. The last form of dividends and dividend tax that we're going to talk about is foreign dividends. Believe it or not every company is headquartered in the United States. Who would have thought? And you most likely own shares of some companies that are headquartered in different countries in Europe or Asia or South America or wherever. Those countries where those companies are headquartered probably have dividend taxes of their own. So do we have to end up paying taxes on our dividends to both the IRS here in the US and to the country of where that company is headquartered? Thankfully not. The US government has tax treaties with over 60 different countries around the world to prevent this double taxation on dividends. So while a country like Switzerland may have a 35% dividend withholding, because of a treaty with the US, that might get lowered to something like 15%. And then on top of that, there's a foreign tax credit which you can claim, which will lower the amount you owe the IRS dollar for dollar for whatever you have to pay a foreign government on your dividends. The rates vary wildly from country to country on dividend taxes and how the treaties and everything work out. So it can get a little complex if you're investing in individual companies around the world, and you should definitely consult a tax professional if you're worried about optimizing your dividend situation for your foreign holdings. Again, if you want to help out this video and this channel, hit the like button down below on this video. If you want to see more of my videos, I recommend starting with these two right over here. Don't forget to subscribe to the channel if you haven't already, and I will see you in the next video.